in the news. Is that true? Do wealthy people not pay their fair share?
We've heard this story over and over.
What's the difference between evasion and avoidance?
This is one that we have to understand gets abused because it's been such a big loophole.
And they don't even have enough income to justify the tax credit.
Warren Buffett pays a lower tax rate than his assistant or secretary.
How is that even possible? Shouldn't they all go to jail?
And so I thought, that's penalizing me for earning another dollar.
That sounds surprisingly made up.
But I want everyone to hear this clearly. Yes, I now have access to all this money, but I'm not paying tax on it.
What are some things that a W-2 or everyday person can do to mimic what the wealthy do?
Weston, you were accused of being AI the other day.
Yeah, well,
Yeah.
I've got a monotone voice, so.
But you're the one that has the brilliance for these videos to come about and representing the audience. So, you do a good job.
That's okay. It could be a compliment if they think I'm AI.
As long as it's like intelligence and not just artificial.
Yeah. Okay, so in the news, we've got a major tax bill coming through. And, people keep talking about how, wealthy people don't pay their fair share, all that stuff. Is that true? Do wealthy people not pay their fair share? And how is that even possible? Shouldn't they all go to jail?
Look, I want to talk about how the wealthy pay so little in tax, why that happens, what taxes they do and don't pay. But most importantly, when you understand the rules of the game, how you can pay less in tax too. Okay, so if we look at how much tax is paid, it's an overwhelming amount of tax comes from wealthy people. But let's look at one issue here, right? There's like a dozen taxes that we need to consider. We pay to drive. There's excise taxes on gas.
Okay.
Right? And then there's even some places that pay for electric vehicles, or you still have to charge an electric vehicle. You pay to sell something, right? We've got sales tax. That's another thing that people are paying all the time. You've got state tax, depending on the state that you live in. You've got property taxes, right? That are on the home, and then so we have to pay to eat, to drive, to buy, to sell, to you name it. There's all these additional taxes, and what people are really caught up on here is income tax. That's what they're really frustrated with.
Gotcha.
They're like, why don't the wealthy pay their fair share of income tax? So the first thing that we really have to look at here is I have to help people understand the difference between an average rate and a marginal rate. See, I was in school and I didn't study for a test, and I had to maintain a 3.5 GPA in college to keep my scholarship. And so I'm taking the test, and it had a question on tax, but it was asking about marginal tax, and I answered it average tax. So if someone were to make $100,000, just to keep it easy, and if they pay $15,000 in tax, that's a 15% average marginal rate. Okay, or not an average marginal rate. That's confusing.
I was like, you can have both.
Yeah, let me just make this even more confusing. That by the end of the video, you know nothing. Average. That's your average tax rate. But the thing is, depending on whether you're single or depending on if you're married, there's a certain threshold that you're paying only 10% tax, right? 0 to 20,000. I'm just making these numbers up.
Yeah,
we can actually show the chart,
brackets,
right? But then it's a step up, and then you have maybe till $60,000. Now you're at 15%, right?
Yep.
And then if we went again and we said there's another step here
to like 120,
and that's maybe 25%, right? And then there's going to be another step at like 35, like, and it just keeps going. But what happens is when you save tax, you save off your highest rate. So if you make, like, I had a belief that if you make an extra dollar, because $23,999 was a 15% tax rate when I was going to school.
Yeah.
And that year, I was at a place where I was about to cross that threshold and be at $24,000. So I thought, now everything is going to be at 20%.
Yeah.
And so I thought, that's penalizing me for earning another dollar. But I want everyone to hear this clearly. The best tax shelter in the world is to earn another dollar, because they don't tax these earlier dollars by a higher rate. They only tax the new dollar the higher rate. That's what's called the marginal rate.
Gotcha.
So that's why it's steps like this, Weston.
So just for clarification, so you'd only have $23,999 tax at 15%,
right,
and then your $1
is taxed at 20%. Yeah. And if I made $2, it's taxed at 20%. And I grew up in this coal mining town, and the coal miners would always say, hey, I can't work overtime, I'll get killed with taxes. They use the word killed. So basically, you're only paying tax on the additional dollar.
Okay.
Which means, though, when you save tax, you save against your highest bracket. So if I save $1 tax, I'm saving against 20%, not 15.
Gotcha.
Because they always save on the last dollar earned, not the first dollar earned.
Okay.
That's really important, and it's why it's so instrumental and it's so impactful to save on tax. And it's really important that we also consider, because there's like a dozen other taxes that we pay, that there's some people that feel guilt or shame if they don't pay more income tax. I know some people, I talked to someone recently making 8 figures, taking only the write-offs for donations and nothing else. I was like, why? Like, well, that's what our accountant said. You're making enough money, don't worry about it. I'm like, no, you're paying so much in tax that's unnecessary. See, because there's this tax code.
Yeah.
And it's not like a bunch of penalties. What it really is a bunch of incentives. It's really saying, hey, there's certain things the government's really good at doing and other things they're not as good at doing. And that they're incentivizing private industry to support what would be good for overall, the overall economy, for overall citizens, for just, well-being. And so those incentives could be housing. You build houses and you get additional write-offs. You can depreciate, right?
Okay.
It could be opportunity zones. Hey, here's a place that has some issues, but we'll offer additional tax incentives because if you do it, it's going to help us out, because otherwise it might be dangerous or dilapidated or a problem. And so there's these incentives. And so, yeah, the first, several pages of the tax code just say why you have to pay tax. And then there's hundreds of pages, if not thousands, that say the ways that you can avoid paying tax legally and ethically. This is what's important. So my first rule in saving tax is, if you're saying that you're doing it, do it. Don't pay your kids to do work if they're not doing the work. That's tax evasion.
Okay.
Tax avoidance is, I am actually paying my kids to do the work, so they learn the lesson of the work and I'm paying them. Some people will do things that are unethical because they're just trying to save tax, that it's something they didn't actually follow through with. So that's the first rule. The second.
So real quick, let's dive into that. What's the difference between evasion and avoidance?
All right. So let's say I'm driving in a car. Okay. Let's see. This is more of a truck. Looks like I'm drawing a little truck here, right?
Yeah.
There's my tires. And then I get to this bridge here. Okay. But it's a toll bridge. There's a little toll that I have to pay this person here. Yeah. If I decide to just drive and not pay, that's evasion.
Yeah.
Now, if up the road here, just up the road, let's say it's a half a mile, and I decided to take this road, and now there's a bridge that has no toll, I've avoided.
Gotcha. Legally.
Right.
It was a little harder.
One was
took a little
evasion.
more distance.
Right. It might take some effort, but that's the difference between evasion and avoiding.
Okay.
So people that evade taxes might, here's a big issue. This is such a big issue that if someone does this is where they get in trouble, is not reporting income.
Oh, gotcha. I got paid $10.99. I'm just not going to report it.
Got paid in cash. I'm not going to talk about it. I'm going to, so if you earn, look, in Italy, that's actually the national pastime. Not reporting income. It's like they would think you're doing something wrong, Weston, if you didn't try not to report at least some of your income. Like, why would you pay the 70% rate?
Is it really that high?
No, I don't know. I don't, but it is higher. But yeah. So not reporting would be a big issue.
Yeah. Okay.
So that would be evasive. Another thing would be just lying. Just saying that you've done something that you didn't do and you're taking a write-off for it.
Yeah.
Some are going to be more egregious than others.
Yeah.
But let's get back to this issue at hand. You're saying, why is it that so many wealthy people can get to near zero on income tax?
Now, is it just income tax, or do wealthy people still have to pay all the other taxes, or do they get around that as well?
Yeah, let me tell you one I didn't mention that they have to pay a lot of. FICA, FUTA, or self-employment tax. They have to pay that for their employees, right? They have to match that. They have, they have those expenses that are that. They have property tax. Some wealthy people have multiple properties. They're paying property taxes. I had over 100 properties back in the day. I'm paying property tax on all those properties.
Yeah.
Right? It's helping me lower my income tax, but I have a big, and this is what happens sometimes when people go, oh, I don't want to live in this state. There's too much taxes. I'm moving to this other state. Is they might have no state tax, but they might have high property tax.
Yeah.
Or they might have a franchise tax. So we have to kind of understand the whole landscape and not just look at it myopically.
Gotcha. Okay.
But how do they get to near zero? Well, one thing is called a real estate professional. So this is one example. It doesn't mean that they're getting some designation or getting a license. It means that they're spending at least like 700 hours on real estate. Right?
Okay.
And it's their primary mode of income.
Is that in a year? Mm-hmm. Okay.
And so that would allow them to be a real estate professional, which can allow them certain privileges for depreciation. And for those that aren't, familiar with all this kind of stuff. So we know that you might buy a house and over time, that house can go up in value, right? But for tax purposes, you might have to replace this door. You might have to replace a window. You might have to change out the carpet. You might have to paint this thing. So they're saying for tax purposes, you get to have depreciation, which means I'm writing it off as an expense. I'm depreciating the asset.
Yeah.
And that could be, there might be additional privileges and less restrictions if it's my primary function or my spouse's. And so that could really help out. When I was in, my 20s and I was doing so much real estate, I paid so little in income tax because I had so much property.
And you were getting depreciation.
Right. And think about it. I was also, let's just say this is the formula. Let's say I was taking 20% down to control a $200,000 asset. Right. So I'm essentially at $40,000 out of my pocket. Right. To control $200,000. If the real estate market goes up 3%, it's 3% of 200,000. Right. So it's a lot. There's leverage to it.
Oh, even though you haven't paid 200,000 for it yet.
Right.
You only paid 400.
I'm getting the value of the full property, even though I'm only using, and I'm also getting to write off on depreciation against this bigger asset. So I only put $40,000 into it, but I have a $200,000 asset
that you can depreciate,
that I'm depreciating. And if I have 100 of those assets, you could see that, especially if I don't have the limitations, if I'm doing this with just a few properties and part-time, I might have times where it phases out and I can't take as much depreciation. So that real estate professional designation is really critically important. And so the other thing that happens with real estate is I've got this property, right? It could go up in value, but I'm not having to pay income tax on that increase, right? It's going up, but it's a capital gain. And I don't even have to pay on the capital gain until I sell the property. And even if I sell the property, I can do a 1031 exchange. So just showing you why wealthy people don't have, which means I can roll it over to another property.
Oh,
it's called a like-kind exchange.
Yeah.
Right? So I could just move that to another property. And I roll that over within a certain period of time, no taxes. And this is a big one. I could borrow. So let's say that $200,000 property after 10 years is now worth $350,000.
Yeah.
Okay. And by the way, I have a mortgage on it that I've been paying on every month. So maybe my loan isn't $160,000 anymore. Maybe it's down to $110,000. So the difference here is I can borrow a certain percentage of that money with the zero tax, because that borrowing doesn't trigger the sale of that asset.
Gotcha. So you can now have cash available through a HELOC or something like that.
Yep, a HELOC, a home equity line of credit, right? Or I could do a total refinance or whatever it might be, but you'll see this happen quite often. And so, yes, I now have access to all this money, but I'm not paying tax on it.
Yeah.
Where if someone in America has a W-2, that's a salary, right? That salary is just taxable. Whereas rental income, right? Maybe I have renters in that property. I have the depreciation that can go against it, right? I have the appreciation that has no tax against it. I could borrow against the equity, and I can even roll the property to another property with a 1031 and not pay any tax. And here's another thing that happens. Depending on when you die and all the rules, but there's a thing that's called a step up in basis. So let's say what basis is. So let's say that property that I put $100,000 of my own money into it, right? But it's worth $400,000.
Yeah.
Well, that's $100,000 of basis of money that I have in there.
Okay.
This other $300,000 is potential gain, right? Potential gain of $300,000 if I sold it. But if when I die, it passes on, there might be what's called that step up in basis, and they act like it was paid for $400,000 passing on to the next generation without triggering a tax. So these are things that why doesn't everyone know about this? Well, if you don't have real estate assets, you don't really not in the conversation.
Yeah. So what are some things that you know a W-2 or everyday person can do to mimic what the wealthy do in saving tax?
They could invest in real estate if they chose.
Okay.
Right?
If it's their,
I mean, they could get loans, they could do stuff like that, and you're going to say if it's aligned with their investor DNA. It's not for everybody. They could definitely set up a side hustle if they're going to keep their W-2. And you see a lot of that with contract work and, you know, different things like that. And now they have a business, and that business can create some tax efficiency.
yeah.
Right? So that would be another thing. W-2 has very few things that they can do to save on tax.
Gotcha.
Very few. They'd have to do it outside of that. There is some charitable type of things that would work with that. If we're talking to a W-2 person, here are my main recommendations.
Yeah.
Number one, I want you to adjust your exemptions. So exemptions are the number you say, like, oh, if you have a kid, if you have all these different things, you can say, all right, I'm going to take 5 exemptions. So I see some people that go, oh, great, I just got a $5,000 refund from the government. Here's how I hear it. I just gave the government $5,000. They paid me 0% interest. I had no access to that where I could have been earning interest on my own. That's what I hear.
Yeah. Gotcha.
So you adjust the exemption so that you don't have much or any refund.
So you would rather pay at the end of the tax year?
Yeah, I don't want to pay enough for where there's a penalty or where it's a problem. But let's just say if it's within $1,000, if you're getting $1,000 back or paying less than $1,000, you know, out, like that's a pretty sweet spot. You're fine. You know, it's hard to do it perfectly, but I wouldn't have any concerns about that. This is the thing. We've heard this story over and over. Warren Buffett pays a lower tax rate than his assistant or secretary.
Yeah.
Right? Story all the time. Here's why. She's paid on W-2. So there's a percentage of that goes to FICA FUTA. You know, that's a Social Security, things like that. And then she has to pay, you know, just regular income tax.
But for clarification, so what they're really saying is he pays less income tax.
Income tax. Oh, there's no doubt. He's got corporate tax. He's got a bunch of taxes. Like usually because of sensationalized headlines, it's like this company paid no tax, but they're not looking at, there's so many things like payroll taxes and things like that. And a lot of it's because Warren Buffett has billions of dollars in stock, right? And he can borrow against that stock pretty much at any time.
And he doesn't have to pay tax on
zero tax. Even if he decides to sell some of the stock. Okay? So he's like, I'm going to sell some of the stock. He's going to pay 20% instead of 37.5%. Now, again, let's go back to why haven't people heard of this before? You got to read What Would the Rockefellers Do? No, just kidding. Shameless plug. Because if you're not in a world where you've got tons of money, and you're not thinking about money every day, you're not hearing about the rules of the wealthy. Because, you know,
because you're not around that.
Look, when you're wealthy, you get into newsletters, you get into like You know, if you're an alumni for a university, they have charitable divisions because they're 501c3s. A lot of these institutions are fully funded. There's just plenty of organizations that if you're the wealthier you get, the more you're invited into events and circles and conversations around this.
Share insights.
And this has been around forever. I mean, it's been around for a very long time. It's just that when we're taught, hey, the way to get money is you work for it. And then with that W-2, you save all the money that you can. But you can't really save tax too much unless everyone comes in, and this is what the not wealthy do. They defer their tax.
Gotcha. Through a 401k.
Yeah. They go, okay, well, what do I do? Well, you take this money, and let's say you have $1,000 that you're going to put away, and you put it in a 401k. And in that 401k, it looks like you have $1,000 in there, but the reality is there's $800 of it that's yours, and there's $200 that's actually the government's, but you decided not to take this $1,000 as income. You decided to defer the income into a plan that's for benefit of FBO, for benefit of you. But you didn't take constructive receipt. It's like you didn't earn it because you didn't take it. So now it looks like you've saved $200 in tax. You go, cool. I put this $1,000 in here.
I'm a genius.
I've got $1,000 in the account, but you can't see beneath the iceberg here. And it's like, oh, wait, but 800, I only get 800. Oh, actually, that's not even true. If you're not 59 and a half, there's a penalty. So you get 700. Now the government gets 300.
Yeah.
So you deferred it and you're like, okay, well, I'm going to defer taxes in the future. And some people say, well, it's because they'll be in a lower tax bracket. Well, how are we going to be in a lower tax bracket? Let's look at the ways. Number one, you have less money. That doesn't sound great.
Yeah.
Just inflation alone makes it a little hard to live off less in the future.
Yeah.
The second thing is government lowers taxes. Are we, 37 or 36 trillion right now?
Oh, in debt?
Yeah.
Yeah.
Yeah, that's right here, right? I think that's the right number of zeros. So how are they going to lower taxes? It's a entity that owes this much money. How do they pay for that?
Yeah.
Through taxes. So you could have less money, they could lower taxes, or you'll have more deductions. But here's the thing. Who has more deductions when they retire than before retirement?
Well, yeah.
Because if you're a business owner, that's a big deduction. If you're putting money in the plan, that says the deductions.
But if you're
deferral.
retired, you've gotten rid of a lot of your deduction possibilities.
So it sucks to have less money. It's unlikely to lower taxes, and you're probably going to have more deductions. So when they're telling you to defer taxes, they're just kicking the can down the road and saying, deal with it later. Because who's better at later? Like if I ask my wife if she wants to hook up and she says later, I'm like, that's the polite way to say no.
No, yeah.
It's a no. It's like, of course, later, but like later. What good happens later? Like if my wife's like, take out the garbage, I'm like, how about later? She's like, how about
How would
now?
you sleep on the couch?
Right? It's like this is just because it's hard for us to understand our future consequences.
Yeah. So with that, if I'm willing to get out of a W-2, what are some ideas of how could I start going on that pathway of paying less taxes?
Okay, so if you are 1099 or you have a LLC, a C Corp, or an S Corp, just something like that, here's what you're going to do. You're going to start taking deductions. So every time you spend money, you ask this question: could this relate to the business?
Gotcha.
If you're unsure, you talk to your tax team.
Yeah.
We'll talk about that here in a second, right? And then if you're like, yes, this does relate, you simply document it. Great resources, easy resources. I don't care if there's apps that you could, that'll organize it. You could take a picture of it. You could, however you document, just document it. And then you start maximizing your deductions. So how do we maximize them? Well, let's just talk about a few. There's one called 199A, qualified business deduction. If you have employees, especially if W-2, you get certain ways to lower the overall tax on all of your income. You can take 132J that just says, hey, I have a pool, I have a hot tub and cold plunge, and I have a gym. So I can write off all the maintenance of that as a write-off as long as I make it available to my employees. Well, I have a company that's just my family, so that's pretty easy. 280G You know, you can use the Augusta rule to rent out your house 14 days a year, and that's tax deductible to the business. If you rent it to the business, it's tax free to you personally, or you can even rent it out to other people and not have to claim the income. You can have a home office now if you have your own business instead of just having a W-2 job, even if it's a side hustle. You know, you can pay your kids. If your kids are 18 or younger, you can pay them just around $14,000 a year if you can think of things for them to do. And guess what? That's tax deductible
and that's
to you.
the business paying your kids, or is that you paying your kids?
Business.
Okay, gotcha.
There's some people that have businesses in high tax states like New York and Illinois and California. And if they have clients outside of those states, then, you know, they could actually set up a wing or a NING, which are grantor defective income trusts, which allow you to take income from people outside of that state through another state, and you don't have to pay state tax when you do that.
That sounds surprisingly made up.
It does, right? A wing or ning. That's just Wyoming. That's just Nevada.
Oh, okay.
So it's not actually a wing ning. It's a wing or a ning, depending on the state that you choose.
Okay.
You know, so you just go through and like you maximize your deductions, but that's not even where the big thing is. Where the wealthiest people are just good at reclassifying.
Okay. What does that mean?
All right. There's 4 ways to do it. Okay. I'll give some examples. If you can move active income to become more passive for tax purposes, if you can go from ordinary income to capital gain, as we kind of showed with the real estate example.
Oh, okay.
There's tax-free options, which I mentioned, the charitable trust, and there's what I call tax arbitrage. Talk about that here in a second. So let's start with number 1.
Yeah.
If I'm the only owner in a business, just me, and it's a business that's not that valuable to be sold, this, you know, Wealth Labs is basically my consulting company.
Yeah.
I can't sell it because I'm unemployable, first off.
Yeah.
It's just me. There's no intellectual property in there. There's no systems. It's just paid for consulting. So I can set that up as an S corp, which I have, and I could take a reasonable salary and take the rest in distributions.
Do they define what a reasonable salary is?
There's software out there where you can analyze it.
But it's just like a comparative salary.
Yeah, I mean, ChatGPT.
Yeah.
I mean, it's just so easy to figure it out. It's just, you couldn't be like, oh, I am a brain surgeon.
And I get paid $20,000.
$20,000 a year.
Yeah.
You know, right? Like there's certain things that, but you can look at like, what's the median? What's the median of what that is? And then you're going more towards the median on what you pay, because you wanted to keep that salary relatively low and take higher distributions. And by the way, you can justify higher distributions if you have infrastructure and team.
So that salary still will be, you'll still pay income tax on that salary.
Yeah, and you have to pay, you know, the FICA FUTA on that too,
but
right?
So that's the idea, is you're trying to lower your taxable salary.
Yeah, you're going to save between 3.2% and 15.3%, depending on how much is coming out, by taking distributions instead of salary.
Gotcha.
So if I have, if I have multiple employees and I've got multiple consultants, and a lot of the income comes in even if I don't go to work that day, I can justify higher distributions because I'm getting paid for being the owner. If I'm the doer, that's what the salary's for.
Gotcha.
The doing. The distributions are for strategy and big picture and vision and those kind of things. So that's one example. Let's just say that I have a brick and mortar place, right? I have a physical location and I'm renting that to my business. I want to do that the highest comparable rent, because rent comes in 1099 without the 15.3% because it's more passive, right? So I'm just classifying the income to come in more passive than active. And this is, by the way, a huge incentive for people to scale properly.
So that's, you have your home, but you're running your business through it.
Nope. Brick and mortar.
Oh, gotcha.
Business. This is the diner. This is the strip mall where you have an office.
Okay.
This is a commercial
location,
real estate.
Gotcha. Okay.
That you own. And if you own that commercial real estate,
you own it as an individual.
You own it, or your business owns it. You want to charge high rent
to your business.
To the business.
Gotcha. Okay.
Yep. And so this is a big reason, Weston, that people would be motivated to scale. See, because actually if you scale, it's more tax efficient.
Gotcha. The larger the building.
Well, not just building. I'm talking about business.
Oh, okay.
If someone is a solopreneur,
Yeah.
and that's it, there's a lot less tax strategy. But as they grow a team and they have more infrastructure,
there's more options for
and
tax.
it's less about what they have to do day to day. And there's more software, or there's more process, or there's more people. Like all of that stuff becomes actually more effective from a tax perspective.
Yeah.
You know, because even we go back to 199A, because now you have employees and it gives you a qualified business deduction, which passes through at a lower rate than if you didn't have an employee. Or now you're big enough, you have to have a building, and all of a sudden now if you want to buy that building, or if you don't work for a whole summer because you go to Italy, but the team continues to provide and grows that business, like it's showing that my salary should be lower because I'm more of a business owner than a business runner.
Yeah. Gotcha.
Right. And so that's another reason for people to scale. Now let's go to this second thing on classification of income.
Okay. So ordinary income to capital gains.
So cap gains. Cap gains might be 0%, 15%, 20%, you know, and basically ordinary income goes up to 37.5%.
Oh, okay.
So if I have a capital gain asset, that might be a stock, that could be a piece of real estate, you know, that could be a business. Someone owns the business. Like anything that could be capital gain, that could grow without tax, right? Mm-hmm. But then when you go to sell it, it has a lower tax rate. Now, that's a good situation, but there's other ways to have capital gains before. One is an international sales corporation, ICDISC. Let's say that you do business with the friendly neighbors at Canada. That they were friendlier before we said they were going to be the 51st state, but friendly, you know, and so ultimately, let's say that you have 20% of your business coming from there. If you take that 20% of the business through an ICDISC, it all comes in capital gain. Why? Because they want that money back in America because you're an American company.
Oh,
they're
gotcha.
incentivizing it with a lower tax rate so that the money isn't kept overseas or isn't kept in the other places. So that's an ICDISC. Another thing, and I have to draw out warning before I do this, okay? So this is a warning because this is something that's been on the dirty dozen for the IRS.gov. So first off, that is actually a pretty good website, IRS.gov, and you can look at like what are the tax schemes out there, what is it that people are up to that the government's scrutinizing and looking at. It doesn't mean that everything on there is bad. It means people are abusing it and probably doing it wrong.
Yeah, I gotcha.
And so this one is on there quite often. Called an 831B. 831B, also known as a captive insurance agency. Mm-hmm. That's how Geico started. Basically, you're a business, and you're like, okay, I want to be able to put up to $2.3 million into my own insurance company.
That's cool.
So instead of maybe paying commercial insurance to all these other places, or maybe it's hard to get insurance. I remember it's hard for me to get a media policy at one time. It was hard as a speaker to get bonded because of the type of topics I was talking about. And so I set up a captive insurance agency back in the day. And so now I had a way to insure, and all that money went in pre-tax. But if I didn't make a claim, it comes out capital gain. If I do make a claim, it's ordinary income. So, and here's the thing, a lot of people aren't making claims, so they're basically doing this just for a tax advantage when it's really a risk management tool.
Oh, gotcha.
That happens to have certain tax implications. There are many issues with them. Number one, they're onerous and expensive and kind of frustrating sometimes to set up. But
the
I just want to give the example.
Yeah, but the stipulation is you actually have to use it as an insurance.
Yeah. So if you never make a claim and there were actual claims to be made, they're like, oh, you weren't using this properly, and you could lose in an audit. And if, let's say that you have a provider, a CPA and an attorney, and their firm is doing things for 100 clients, and one of those clients is doing something wrong. They have to invest with certain restrictions. Like, what would an insurance company be able to invest in? They're not letting them invest in Bitcoin. Yeah. So say that they go put all the money in Bitcoin, and the reason is because Bitcoin has volatility. and it has to have stability. And so if you invest in things outside of what the norm is, it could end up being that they come after and say, oh, look at this. They're not doing this right. And this is just a way for people to put money in pre-tax to Bitcoin.
Yeah.
And and then everyone that's with that firm now gets audited. So you have to have someone that's really good. But it's important, just, these are something that wealthy people use. They're putting $2.3 million a year into this pre-tax. It's capital gains. We're answering the question. The third one is tax-free. And I already talked about one of them, which is my favorite, which again, what would the Rockefellers do really goes into that, which is the charitable trust. But I also just want to mention a section 1202. If you're a C corporation, you've been around for at least 5 years, and you're in the right type of business, meaning that you just qualify, you have to understand what it is they're asking, you can sell up to $10 million tax-free per partner.
10 million what?
$10 million in sell. You sell the business.
Oh, gotcha.
Normally there'd be $2 million owed to capital gains. You would own nothing on that first $10 million.
Wow.
It would just be an exclusion through 1202. So that's an example there.
That's cool.
Now, yeah. So the last one is one that I've been doing. And this one, I believe Matt told me, is this on the Dirty Dozen now too? Art? Yeah. Okay. So this is one that we have to understand gets abused because it's been such a big loophole. And in Europe, everybody that wants to, museums that want art, they pay for it.
Yeah.
Or maybe they have it on display for a short period of time and it's someone else's that owns it privately. In America, it's mostly donated, which means there's major incentives to donate art. But when you buy the art, so if I buy the art and I just, donate it 1 year later, I can donate it for basically what I paid for it. It's called book value. Okay.
Okay. So you buy it for,
if I pay $10,000 for the picture, I donate it, I get $10,000. If I wait for 3 years, it goes to the appraised value. There's probably people that are using appraisals that aren't legitimate. There's probably people that are overinflating this is why it's there. But I've been doing this since 2006. I've been audited twice. I mean, my art dealer is amazing and he's been doing this for a very long time, so I'm doing it right, which some people don't. I just bought more that we're putting up at the house right now. It's getting framed. And so when I buy it, let's say I pay $75,000 for the whole collection, I'm going to make sure that that is worth at least $400K or more based upon purchasing. The way that works is I make a deal with the artist not to sell the art. So I buy a collection. They do a deep discount because they're offloading a lot at once. And they also know it's going to be displayed at museums, which is good for their brand.
so it's a win-win.
Definitely.
That's cool.
So, but I have to hold that for 3 years.
Yeah.
One of the issues we have is we fall in love with the art and we don't want to donate it. Now, today I sat there, I have a safe here at this place and it's safe because after 30 minutes I couldn't get into it. I have the codes, but I don't know how many times it goes right, how many left, how many, is it 3, 2, so anyway, I was going to put some of the art in there.
Just like most people's Bitcoin wallet.
Yeah, the good thing is I have, my seed phrases in a different place than I have, but basically, I was going to store some of the art that we decided not to display. There's another thing that people could do here.
And then you just get that as a tax write-off.
Yep.
Right.
And usually if I'm spending $1, I'm typically saving $2. Which the big thing here is most people let the tax tail wag the dog.
Yeah.
Right.
So I buy a big, massive SUV.
Right. And I get to do a section 179 on this, which means I get to write all of it off right away in the first year, for depreciation. And then the actual vehicle depreciates and it's worth less than what I paid for it. And I just spent $1 to save 37 cents.
Yeah, and I have a vehicle much bigger than what I actually needed to buy.
This doesn't make economic sense.
Yeah.
Like when I see videos, the really wealthy people, they buy used cars and they never take that hit. And then and then other people like, wealthy people buy exotics because they know that they appreciate and they get to enjoy it and be douches online with them, whatever it is. But the thing is that neither is really true.
Yeah, it sounds like a lot of people don't know what the wealthy
actually do. The truth of the matter is people are wealthy because of who they are, how they operate, how they create value, not how they buy a vehicle.
Yeah. Gotcha.
Does this make economic sense first? Then consider the tax implications.
Yeah. I mean, it's like this.
So this is the first priority.
It's like the
tax is
solar
the
panel
second.
incentive is a big one right now, where it's like people are getting these solar panels and they don't even have enough income to justify the tax credit.
Right.
Yeah.
It just, this is an important concept, is capitalization.
Yeah.
So this is how I look at tax. I had someone in one call save me $179,000 in tax.
Wow.
We did R&D credits. We did something else, DPAT or domestic production credits. Those were two of the major things that we did on this call. So I was able to go back and claw back and get some money. That was awesome. Now, if you think about it, some of that was just a one-time thing. But I've just worked with so many people over the years where they might save, the average was like $10,430 per 500K. That was the average savings.
Yeah.
So if you think about it, how much money does someone have to have in today's economy to create $10,000 per year safely?
Yeah.
I mean, the reality is they probably need $200,000. Now, how easy is it for someone to get $200,000 into an investment? We either need some time,
Yeah.
right? So it could grow, or we need to have the money so that we could, allocate it,
throw
right?
it in there.
And get it there. There might be risk that's required for that money or for that time, right? There might be the actual opportunity cost of our time that we spend trying to get to 200,000. Like, to get to 200,000, there might be taxes, on the earnings. There's just a lot that could happen. So it takes time. That one call, that someone saves $10,430 is like finding 200 grand, because that's how much you'd have to create that every single year cash flow.
Oh, gotcha. Yeah.
Right. And so that's capitalization. And this is where my philosophy backfired on me, Weston. This is it. Okay. Because we move into our house August of 2021. Beautiful. My wife calls it our forever home. I do think it is. I love it. Love the view. Love everything about it. You've been there many times.
Yeah.
And then we go for 3 years of her saying, you know what? You're supposed to take 10% of what you pay for your house and put that towards your yard. And I was like, we already have a yard.
Who says that?
My wife researched it on ChatGPT. They. So I'm like, okay. And then she got an actual architect to back it up, and then she got
Okay.
I mean, she is a researcher.
Cool.
I was like, that's crazy. So then the first year goes by, and she brings me a little spreadsheet that shows $1,400 a month to water the yard.
Huh?
$1,400 a month, because our backyard looks like this. It was a little here, and then it's just really steep hill.
Yeah.
And so just the retaining wall, when we first got it quoted, was $100 grand. I was like, no, that's crazy. But then what did she do? She goes, look, if we take and we invest $300,000, she used the word invest with me, $300,000 into this yard, that's going to save us $1,000 per month, or $12,000 per year.
On the water bill.
On the water bill.
Gotcha.
Okay? Just on the water bill.
You're not flooding your neighbors downhill.
Right. So I'm like, okay, 12,000. She's like, and if we were to put that somewhere really safe, what kind of interest would it get?
Okay.
I was like, well, we could safely get 5%.
Yeah.
She's like, cool. So basically, 2/3 of the yard is taken care of just by the water savings.
Okay.
So she's like, all I'm really asking for is that extra $100,000 so we can have limestone and we can have a beautiful fireplace, and let me sell the vision. Let me show you the design. And I was like, I think that she's going to start selling for the company. It was very, and now it's almost done. And I'm like, it's pretty amazing.
It looks good. Yeah.
It's really great. Like even though every dollar we spend, I'm like, that could have went into Bitcoin. That could have went into growing a media company. But you got to live life. You got to enjoy it along the way. It's not just about one day, someday. So have to live what we preach. But But that's the thing about tax savings is in 20 minutes or in an hour with the right team and this framework. I mean, when I was, when I had that lunch with those 20 billionaires, they were all spending millions of dollars on their tax team to save hundreds of millions of dollars.
Wow.
What happens when you're really, really wealthy? It's very custom through tax attorneys. So there, you might have seen like really wealthy people have a lot of collectibles.
Yeah.
Right? And those collectibles often are because they're businesses that create major write-offs, but they're all built. They're not off the shelf. You don't go, oh, you know what? I want the tax strategy called 199A. I want the tax strategy called write-off a home office. I want the tax strategy called the Gust rule. These aren't like that. These are built from scratch with bright minds.
Oh, like to their specific circumstance.
Their specific circumstance.
Looking at the tax code and coming with creative ideas.
Yes. To completely write things off in massive ways.
Wow. That's crazy.
Yeah. And those are very custom. And so, that you don't hear about those quite as much, but you look at, they've got money in cash value insurance that grows without taxation. It's available along the way. The death benefit comes in tax-free. They've got capital gain assets that have a step up in basis and, don't get hit with tax when they pass it on, that they could roll over to other like-kind assets. They borrow against those things. They pay no tax when they borrow against that. And then they just have really good tax teams. They don't have historians. Historians just tell you what you owe. And they have you defer your taxes, just kicking the problem down the road. They have tax attorneys, not just attorneys, that look at their corporate structure, because the type of corporation you choose massively impacts how much tax you pay. If you're just a sole proprietor and you don't have a corporation, not only do you have 100% liability.
Yeah. You're also getting taxed twice.
You have 400% higher chance in being audited.
Really?
And you also have a 100% chance that you're overpaying on tax.
Jeez.
So what happens is people are like, well, I saved the money by not hiring an attorney. And I'm like, cool. You saved the money and you gave it right to the government. But don't worry. It's in good use.
It's in good hands.
It's in great hands.
So to finish it off, are there some ideas of, okay, I'm working for W-2 right now.
Yeah.
Can I create a business and ask my employer if they would pay that business?
Yeah, you could see if you get bonuses in 1099. There's some businesses have to pay W-2 based upon
What's
the legal structure, and they require you to be there at certain times. And there's certain others. There's people working from home. They make their own schedule. That would allow the flexibility to. And what I love is say, if I can find a way to impact the bottom line, can I get upside potential? If I could, that's so easy with sales, right?
Yeah.
That's really simple.
It's like I sell
but there's
more,
also,
you give me a percentage
that could be amazing for savings. Someone goes in and says, hey, if we go to this software, if you have inefficiency here, you're not using this, like find ways that you could show them measurable percentages or dollars, and then you get a percentage of participating in that. Gotcha. That would be phenomenal. And if that could come through 1099, then you're in a great situation from a tax perspective.
Because I feel like a lot of people, especially who are in W-2, have this fear of 1099.
Right, because we've been sold this notion of you go to work to get the benefits.
Yeah.
Right? What does that say? Benefist.
Yeah, it's pretty much what it is. It's a
benefist.
It's a gut punch.
Not benefits, it's benefice right in the gut. Yeah. There's nothing to fear that way. We have, and plus, I have, like Trisha, she has a salary with me as my assistant, but every time someone hires me to speak, every time someone comes to do a cash cabin, she gets a percentage, and that's a 1099 to her company.
Oh, okay.
Sensational Ventures. Like it's just, like I send that, and so that's very efficient for her.
So people could do it towards like they get paid W-2 for the main part of their income, but then bonuses or other things can go to a 1099.
Yep. I mean, they got to talk to an employment attorney as the employer, especially a big employer, to make sure they navigate it properly. So it depends. But I love that you brought this up and have people think this way.
Cool. Gotcha. Well, sweet, man. So then I guess we shouldn't throw all of our wealthy people in prison.
No, because they're paying so much tax, property tax, self-employment tax. They're paying excise taxes, sales taxes. There's so many taxes that they're paying. And so are the people that are paying taxes.
Yeah. I looked it up. Elon Musk, just through Tesla, had paid an estimated $2 billion in taxes.
Yeah.
And it's like,
But all we're going to hear about is Jeff Bezos didn't pay tax. What a dick. And we heard it while we were ordering from Amazon.
Yeah, and while
ordering our book on how not to pay taxes from Amazon.
Yeah.
So, all right, man.